Welcome to the Explainer, everyone. All right, I want you to imagine a business that literally benefits from every single airplane taking off. And by the way, that happens about 100,000 times a day. Every major military budget increase, every commercial flight hour logged globally. That's the day-to-day reality for Safran SA. We are looking at an absolute European aerospace titan here, a company with a staggering market cap flirting with the 150 billion euro mark. And hey, if you've been watching the markets, you already know they've been on an absolute tear, delivering a massive 27% share price increase just over the last year alone. The momentum is breathtaking, and honestly, the sheer scale of their operation is something that any focused investor really needs to understand. But here is the absolutely critical question we need to ask ourselves and our wallets right off the bat. With a 27% run-up already in the books, is there actually still room to run, or are we just buying at the peak? Has the broader market already priced in all this fantastic news, essentially leaving late arrivals holding the back? Well, that is exactly what we're going to figure out today. We're going to cut through the hype and look strictly at the numbers. Here is our roadmap for today. First, we'll look at the aerospace powerhouse itself. Second, we'll unpack their financial engine. Third, strategic expansion moves. Fourth, we'll tackle the bear case risks. And finally, we'll deliver the ultimate verdict. Let's get right to it. Okay, part one, the aerospace powerhouse, setting the scene. As a business profiting off the literal physical utilization of global fleets, they've built a pretty incredible moat. Moving on to part two, unpacking the financial engine, specifically their first half 2026 breakdown. 17.6 billion euros. Just let that number sink in for a second. 17.6 billion. That is their revenue for just the first half of the year. We're talking about a 20% organic jump. But, a great growth narrative doesn't mean much if you aren't actually converting it to cold, hard cash. Well, alongside that massive top-line growth, they managed to expand margins by 18.4%. That drove a staggering 29% jump in operating income, hitting 3.2 billion euros. Growth is great, right? But profitable growth at this massive scale? That is exactly what makes institutions pour serious money into a stock.
Then there's this number, 1,030. That is the exact number of LEAP engines Safran delivered in a mere 6 months. It's a 41% increase. Now let's put that into perspective. We have all seen the constant headlines about supply chain chaos absolutely crippling the aerospace industry, right? So when you consider that a single commercial aircraft engine has tens of thousands of complex parts, managing to hit a 41% increase in deliveries during global bottlenecks, that is an absolute masterclass in manufacturing execution. So the crucial question becomes, what exactly is fueling these incredible numbers? It really boils down to two massive engines of growth. First up is the high-margin aftermarket. When airlines fly their Boeing 737 MAXs and Airbus A320neos more often, well, those LEAP engines need more spare parts, they need more routine maintenance. It creates this incredibly predictable, high-margin cash flow. Second, we have surging defense spending. With geopolitical instability stretching from Eastern Europe all the way to the Pacific, governments are frankly opening their wallets wide for Safran's military tech. We're talking optronics, avionics, advanced navigation systems. It's basically a perfect dual revenue stream. Let's transition to part three, strategic expansion moves. Let's see how management is proactively securing the future. A truly great company doesn't just ride the current wave. They build the surfboard for the next one by aggressively deploying capital. They aren't just sitting back reacting to this massive demand. No, they are proactively capturing future market share and structurally improving their long-term margins. Think about these two brilliant defensive moves. First, you have a 280 million euro investment in a brand new Morocco plant, specifically geared for Airbus A320 landing gear. This scales up their capacity while securing a much lower cost manufacturing base that's still nice and close to European supply chains. Second, there's their acquisition of the remaining stake in Aubert and Duval. This is pure vertical integration at its finest. It locks down their supply of critical raw materials like titanium and special alloys. Think about it. While competitors are out there getting completely squeezed by supply shortages, Safran went out and literally bought the supplier to protect their production lines. It's a huge strategic flex. All right, on to part four, the bear case risks. It's time to navigate the headwinds. Intelligent investing is first and foremost about managing risk, so we absolutely need to navigate the systemic hurdles that could potentially derail this whole growth story. Let's clearly outline the three major threats here. First, the premium valuation. At a forward price to earnings ratio of 31, perfection is practically already priced into the stock. Any slip-up will hurt. Second, and honestly, this is the one that probably keeps their CEO awake at night, rare earth dependencies. A huge chunk of the world's critical metals are processed in China. Now, Safran is stockpiling, sure, but a sudden shift in Chinese export policy, that could severely disrupt their operations. And third, execution fatigue. I mean, they are ramping up production, building new factories, and integrating fresh acquisitions all at the exact same time. They need to hire over 500 highly skilled workers just for that new Morocco plant alone. In today's tight labor market, persistent engineering labor shortages are a very real, very present threat. The gap between the current price and analyst targets perfectly illustrates that valuation risk we were just talking about. The current stock price sits up around 362 euros, which literally exceeds the average Wall Street target price of 343 euros. What this means in practical terms is that there's a lot of air under the stock right now. If the company stumbles on literally any of those execution risks we just discussed, or if margins contract even a tiny bit, there's very little fundamental support to keep the price propped up at these heights. And frankly, this is exactly why Wall Street's current consensus from major players like Goldman Sachs and Barclays is technically a buy, but it's heavily caveated as a cautious buy. And let's be real, that's often just analysts speak for, we don't want to miss out, but we're pretty nervous. They're only projecting a 2 to 5% upside from current levels. That is definitely not a high-conviction, table-pounding buy recommendation. It's a low-conviction trade. For this stock to really soar significantly higher from here, they're going to need a massive, unexpected catalyst. We're talking something like a surprise multi-billion euro share buyback program or winning an entirely new, highly lucrative fighter jet engine contract. Without something huge like that, the upside is pretty heavily capped. That brings us to part 5, the final verdict. Buy, hold, or sell.
Stepping back, we've looked at the undeniably bullish momentum, and we've soberly assessed those very real bearish risks looming on the horizon. To synthesize all of this data into a single, actionable takeaway, I want to leave you with this really powerful concept. Safran is a fortress. It really is. They enjoy a dominant market monopoly in their partnership with GE. They have massive, highly predictable aftermarket cash flows that heavily insulate them from short-term economic shocks. Plus, management is out there making incredibly sharp, proactive moves to secure their supply chain. There is virtually zero risk of a cash crunch here. Fundamentally, they are structurally sound. But, as we know, structurally sound doesn't always mean cheap. Because the risk-reward ratio is currently so incredibly balanced, and because the stock is historically expensive right now, our final verdict is this. Hold it if you already own it. The easy, massive gains from the post-COVID dip, those have already been made. If you're looking to start a brand new position, the smart play here is to just be patient. Wait for broader macroeconomic volatility to naturally drop the price by, say, 10 to 15%. That right there is where the margin of safety opens back up for the value-conscious buyer.
Which leaves us pondering the future with one final, pretty provocative question. When the upcoming 2027 guidance is eventually released, will they actually be able to maintain this blistering 20% growth rate? Because let me tell you, that guidance is going to be the next major catalyst that either wholly justifies this premium valuation or pops the bubble. Keep a very close eye on it. As always, please remember that this explainer is strictly for educational research and is not financial advice. Thank you so much for hanging out and learning with us today, and I will catch you in the next one.